I'm going to be providing you with a framework from which to think about the stock market and hopefully better understand the stock market, especially when people are starting to recommend stocks or sectors to you to invest in. First, let's understand what a stock is. When you invest in a stock, you become an owner of those companies. And that's very exciting. You have ownership. They give you a lot of information about it from an owner. It's typically called an annual report or a 10K, but there's a lot of information that goes along with being an owner of the company. There's two ways to make money in general. Number one, the stock goes up. That's what people think about. Stocks going up is very, very exciting. Number two, dividends. And dividends is a way of reaping typically a percentage of the company's profits. Many companies are growing and don't return any profits to shareholders. They have zero dividends. Others 1%, 2%, 3%, and so on. And so there's two general ways to make money in the stock market. Now let's just think about the stock market in general. Okay, stock market in general, people think about the stock market went up and down. What they're really talking about usually is the Dow Jones Industrial Average. Dow Jones Industrial Average, though, is really just a composite of 30 stocks. There are 30 stocks that mirror the general economy, and they do represent the stock market in general. But there are only 30 stocks. There's a broader index that some people have heard of called the S&P 500. The S&P 500 are 500 stocks. But again, it's just an index. So those are indexes that reflect the general economy. And what's interesting about those indexes is it's very hard for the average layman to beat those indexes. We'll come back to that point later. Okay? So when you think about the stock market, let's kind of break up the stock market and look at it as pieces, just like investors do. Okay? So the first breakup is geography. And in general, people think of domestic stocks, those headquartered in the US, and international stocks, those headquartered overseas. Okay? Domestic and international, but international breaks up into many pieces. It could be geography, or let's call it continents. So you could have Europe, Pacific, Africa, and any frankly continent, or particular countries. Okay, so they could be German funds, okay, China funds, and or they could be regional. Okay, so very often people like to invest in China, but really want to invest in that region of the world and may just invest in a Pacific or Southeast Asia fund or something like that. Okay, so international can break up in many different parts. The other one is emerging markets versus stable markets, the ones that are established. The emerging markets, the ones that are growing very rapidly. Indonesia, let's say, or Thailand, or Singapore, or China. Those are the ones with growth well over 5%, when most of the more established countries are at 1, 2, 3% growth. Okay, so that's geography. The next one that most people have heard of is size. And in general, what I have here is small, medium, and large. Okay, and small cap companies, and they're generally by market cap. And before we get into the size, market cap is basically the value of those companies. And when you think about the value of the companies, you go, well, what does that mean? Well, that basically means the number of shares outstanding times the dollars per share, what they're selling for. So if you bought a stock and it's worth $10, okay, and you know it has 1,000 shares, okay, that market cap of that company would be worth $10,000. And that's in general how companies are valued when you think about market cap. So the small market cap companies are typically going between $500 million and $2 billion, let's say. Okay, sounds very large, but bottom line, those are small caps. There's some that are called micro cap, and they're even under $500 million, which we won't be talking about. Mid cap stocks are those caps typically between $2 billion and $10 billion. And then large cap stocks are those over $10 billion in value. Now when you think of that, that's a big company, $10 billion. Apple Computer, which is one of the largest, if not the largest today, is valued at over $700 billion. So that's a huge company. Okay? GE, which people think of as probably the next largest company, has a market cap today of $275 billion. So those two companies have spread, in terms of Apple just doing terrifically well in the last number of years. And so that's size. Okay? In general, the smaller the company, the riskier the company, in terms of volatility, in terms of information that they're gathering, in terms of potentially a dependence on one or two products. So in general, higher the risk, smaller the company, the larger companies have lower risk. Next is strategy. Okay, and the strategies really break up into value. Okay, and value is where all of a sudden a stock falls out of favor. And what comes into play here is called a PE ratio. Let me just explain what that is. For every dollar of stock, for every earnings, P being the P price over earnings. For every dollar of earnings, the price is, let's say, in a 10-to-1 stock is a $10 stock price for a dollar of earnings. The growth companies have $30 prices for a dollar of earnings. So people are valuing those dollar of earnings much more in a growth company. And why is that? Well, in a growth company, you're expecting next year to have earnings maybe $2 a share or $3 a share. So although it may make intuitive sense, wow, why don't I just invest in low value, low PE stocks? The reason is the growth companies are more than likely going to grow their earnings and therefore hopefully going to grow their price of their shares. And so what you have is value companies like, let's say, Exxon. Okay, Exxon is part of the energy industry. Okay, today they're only valued at a PE of about 12-to-1. Okay, it's fallen out of favor. You only have to pay $12 for every dollar of earnings. Growth, let's think of Google. Google has a PE ratio today of about 27. Okay, so that same dollar of earnings, you have to pay $27 in Google. The only difference is, and we all know, Google is growing very, very rapidly. A lot of people are very, very confident of its future. And lastly would be a diversification, and a diversification is really a diversified strategy where you have a little bit of everything. Okay? The last category would be industry, and industry breaks up into many different categories. I just named a few here: the high-tech industry, healthcare, telecom, industrial companies, many, many different types of industries. Okay? And in general, the higher growth industries have higher risk. Okay? So this is basically an entire, kind of a map of equities. Let's go back to the point that I made earlier in this videotape. In general, when you say, okay, now let's talk to my stock broker, and he's now telling you which stocks to invest in, or even which segments to invest in. At the end of the day, and this is an extraordinary statistics, most of the experts, okay, most of the people who run mutual funds, the people who work on Wall Street, don't beat the overall index, the S&P 500, after you pay their fees. So why does Warren Buffett say, you know what, for the average layman, just invest in the S&P 500? What he's saying is it lowers your costs, you don't have to pay a lot of money to stockbrokers, and in general, you're going to do better than the typical person who's going to be recommending or advising you as a financial advisor. So my overall advice is it's very good to understand this, but investing in the stock market is very tricky, and you're best off just investing in the S&P 500. Thank you.